Every year, I help agency owners legally keep more of what they make, and every few years, one of those same owners sits across a table from a buyer and watches those exact moves cut the price of the agency. Not because the strategies were wrong, but because nobody ever wrote down why they were right. Here's how that math actually works. It's worse than most owners expect, and you can't fix it in the month before a sale. When a buyer looks at your agency, they're not asking how much profit you made. They're asking how much of it is real. That's earnings quality. It's a completely different question from earnings level. A buyer doesn't buy your net income, they rebuild it. They take your reported profit, add back what looks like personal or one-time expenses, subtract what they think is missing, and land on their own number. That's called adjusted EBITDA. Then they multiply it. And the last part is the whole video. Every dollar they can't verify doesn't just disappear, it disappears but gets multiplied. Say you ran $40,000 of legitimate expenses through the business last year. The car, some travel, a phone, a family member on payroll. Every one of those can be added back to earnings for a buyer if you can support it. But if you can't, the receipts are gone, the coding changed halfway through the year, and the reason lives in your head, so the buyer refuses the add back. Your adjusted EBITDA just dropped by 40 grand. Now say the market's paying 5 times earnings. I'm using 5 just as an illustration, not a promise. That's $200,000 for a filing habit that takes 10 minutes a month. Now here's the part almost nobody tells agency owners, so stay with me. Add backs cut both ways. Owners assume normalization only helps them. The buyer's team goes through the P&L, pulls out the personal stuff, earnings go up, everybody's happy. But that's only half of it. A good buyer subtracts too, and the subtractions hurt more because you never see them coming. You pay yourself a modest W-2 and take the rest in distributions. The IRS expects reasonable compensation for the work a shareholder employee actually does, judged on things like duties, hours, and what comparable roles pay. So now you've done 2 things at once. You've created tax exposure, and you've hidden what your own job really costs. A buyer normalizes it, right back to where it takes to hire somebody to do what you do, and your earnings fall by the difference. You own the building, and you charge your company below market rent. Feels like a win every year, right? A buyer will restate it. A buyer restates it to market and takes the profit back. You never hire the salesperson or the controller or the second in command. The buyer prices in the hires they'll have to make. None of that shows up on your P&L. All of it shows up in their offer. One more, and the one that I see the most. Plenty of agencies keep the books on the cash method. For the tax return, that's often perfectly legal and perfectly smart. No buyer values an agency on cash basis numbers. Invoice a client in January for the whole year, and cash books show a monster January and 11 quiet months. A buyer can't find your run rate in that. What they can't find, they discount. You don't have to change your tax method. You need accrual management reporting running alongside it monthly. So when a buyer asks for 3 years of accrual earnings, it already exists and it ties. You can't build that backwards. That's the entire point. So 3 moves, whether you're selling in 12 months or 12 years. 1, separate everything. Business accounts, business cards, business only. Anything personal that runs through the company gets coded to its own account, so it's findable in one search later instead of reconstructing from memory. 2, start the add back schedule now. Better yet, don't keep it in a spreadsheet at all. Tag those items with their own class in QuickBooks, so it's not an archaeology project you survive. The amount, why it would recur for a buyer, and where the support lives. Update it with your monthly close. This is the one document that you don't manufacture later. You need to do that monthly. 3, run accrual management reporting every month. Keep whatever tax method is right for your taxes, but run accrual next to it for your own decisions and for diligence. To that matter, the book should be kept on the accrual method, and every month you should do an accrual to cash conversion on the side so you understand what your cash profit is, what your accrual profit is. Remember, the buyer is interested in the accrual profit. But remember, none of this means stop doing tax planning. If you heard pay more tax so your books look pretty to a buyer, I failed, If you heard pay more tax so your books look pretty to a buyer, I failed. Keep every strategy that's legitimate, build the file that proves it, because the owners who get through diligence in an afternoon aren't the ones who did less planning. The same money as everybody else, they just wrote down why while the reason was still fresh. In 23 years, nobody has ever called me to say they cleaned up their books too early. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.